Welcome and thank you for joining us this afternoon. The webinar is about to begin. Until we begin, I just want to go through a couple of housekeeping items. First and foremost, you are on mute and video has been disabled. So feel free to let your dogs bark, your doorbells ring, and enjoy your lunch or sit in your pajamas and watch our amazing show this afternoon. We cannot see you. We would love to hear your questions. So I encourage you to use the Q&A button at the bottom of your screen. Throughout the presentation, we'll get to as many questions as we can, and we definitely want to hear those. And I get this question every time. We will be recording the seminar. It will be available for you after the presentation, and we will also share with all of the registrants a copy of today's deck. So without further ado, we will be talking about navigating market volatility, the tariffs and market reactions. We've all read the news. We've been experiencing the last 100 days. And Matt's here to guide us all back to sanity, right, Matt? So without further ado, Loxley, if you could change the slide. My name is Rebecca Chandler, and I lead the client service team for the ABA Retirement Funds program here at Voya Financial. And with me is Matt Perlengas. He's the portfolio manager for the ABA Retirement Funds investments, the core lineup of investments available through the ABA Retirement Funds program. And he's with our trustee, Mercer Trust. Can move on, please. Today's presentation will talk about a 2025 market update. We'll talk about an economic outlook for the remainder of the year. We'll look at the program's investment platform. I'll share some program resources and information to help you make guided decisions. And of course, we'll have time for Q&A. So with that, Matt, I hand it off to you, friend.
Awesome. Thanks, Becky. I appreciate it. So let's jump over to the first slide here, and we'll talk a little bit about what's happening this year. It's been a pretty quiet start to the year, so should be a pretty quick discussion. So what we did was we took the exact same slide we actually used for our New Year, New Markets webinar for those who were able to join earlier this year, and we just tacked on the beginning part of this year. So just a quick recap for those who were unable to join. Last year was a pretty strong economic environment. So what we plotted on this chart was a number of different investment categories. So the yellow line is MSCI ACWI. This is global stocks in general. The green line is domestic equities, US stocks. And then the light blue and dark blue lines are international, developed, and emerging market equities. So even though there were some ups and downs last year, some economic data, an election, markets generally ended the year up. And the S&P had a very strong year, up 25% for the second year in a row. And that's that green line all the way at the top. Flash forward just a couple months later, and we see a dramatically different economic environment. And there are two major stories that happened coming into this year. So the first was an announcement by a company called DeepSeek that announced a large language learning model or an artificial intelligence model coming out of China that called into question some of the dominance of US technology companies that have appreciated so much over the past couple of years. And so that caused a little bit of selling pressure in US equities, but really what the major cause of markets moving this year was the tariff announcements. And that's what we're going to be spending a lot of our time talking about today. So if you look over at the right-hand side, coming into February, March, a pretty dramatic sell-off in domestic equities in particular, culminating in the Liberation Day announcements, which resulted in a very dramatic sell-off. Subsequent rebound, but there's still a lot of market uncertainty around the future path of tariffs. So let's spend a little bit of time talking about that on the next couple slides. So I think if we go to the next slide, in order to start talking about tariffs, we got to understand what is a tariff. So we just pulled three definitions here from the World Trade Organization, the Tax Foundation, and Investopedia. My favorite source for investment information is Investopedia. I don't think I could have gotten through college without it. It's very, very helpful. But in general, all these definitions say something somewhat similar. So essentially, a tariff is akin to a tax that's imposed by a government on goods imported into the country. And a government may do this for a couple of reasons. They may want to raise revenue. It is a tax, so it's a way that government can earn money. They may want to protect a certain industry. So if they want to protect autos, they could put tariffs on foreign autos to make U.S. manufacturers comparatively more attractive. And finally, the most potentially slippery slope of tariffs, a lot of times tariffs are imposed because other countries impose tariffs on them. So as a retaliatory measure is a very common reason why one country may impose a trade barrier or a tariff on another country. So let's go to the next slide, and we're going to dive into a little bit more of the mechanics of how a tariff works. And before I give anyone too bad flashbacks of their high school or college economics classes, I'm not going to go through that chart on the left-hand side in too much detail. They're kind of complicated to model, but they have been modeled for quite a while, and it's fairly well understood how tariffs work and how they impact the economy. But let's talk a little bit more simplistically about some of the impacts of tariffs. So there are some potential benefits and some potential drawbacks. We already talked about a few. So one of the potential benefits is generating tax revenue for the government. It's just a way, instead of doing a tax on housing, a tax on income, a corporate tax, you can impose a tax on imports, and that's what's called a tariff. And you can also use it strategically to protect domestic industries, as I mentioned, the example of autos. That's another common reason why benefit, potentially, if you're looking to achieve a very specific goal by imposing that tariff. There's also some major drawbacks of tariffs. So at the end of the day, a tariff is inflationary. It increases the cost of something because it applies a tax to it. So all else equal, if you are buying a good that has a tariff on it, it's going to cost more than an untariffed good, similar good. It also has the impact of reducing choice for consumers. So a lot of times when importers add variety, and it gives our consumers a lot of different options. So if let's say you're shopping for a new car, and there may be about a dozen models of a small SUV, you may actually have fewer options going forward because maybe certain manufacturers may choose not to import to the United States because it becomes economically unviable, or maybe they only import 1 or 2 models instead of 3 or 4. So oftentimes tariffs can lead to reduced choice for consumers. Another element on this raising the prices bit, it's not on the chart, but the way that tariffs are implemented, they tend to be a regressive way to tax. And regressive meaning it impacts the lower income spectrum more dramatically than it impacts the higher income spectrum. So sort of as an example, think of the richest people, the Jeff Bezoses of the world. Their wealth is thousands of times greater than the average American, but Jeff Bezos likely doesn't own thousands more cars than the average American. So as people and consumers gain wealth, they tend to rotate into more services. So travel, experiences, services, healthcare, are all categories that grow. They don't tend to buy 40 or 50 cars, even though they might be 40 or 50 times more wealthy than the average family. So again, it impacts the kind of bottom line of the lower income consumers more than higher income consumers. And finally, the last bit, and this was a key part of the most recent announcements, is the announcement of tariffs or trade barriers can often lead towards retaliatory tariffs or trade barriers by other trading partners, even absent the objective to raise revenue or protect a strategic industry. So I do want to talk a tiny bit about that chart to the left, and take a few minutes to explain about trade advantage, so absolute advantage, comparative advantage in trade. And Adam Smith, an economist from the late 18th century, wrote a book called The Wealth of Nations. Many folks have probably heard of The Wealth of Nations. And this was later expanded upon by David Ricardo, who wrote a less interesting titled book, I think it's on taxation and the political economy, where he further elaborated on that and developed the idea to comparative advantage. And the example Adam Smith used in his book is an example of England and Portugal. And so thinking about why both economies can be better off overall if you have trade and low trade barriers. So think about England. For folks who've been to England, it's pretty conducive, or think about England maybe 200 years ago. They had had gone through the Industrial Revolution. They had a lot of plants. They had built water wheels on their rivers. They had a lot of sheep. For folks who've been to England, there's a lot of sheep in England. It's very well set up to produce wool and textiles in these factories. Portugal, on the other hand, it's a sunnier climate, better climate, and conducive to growing wine and creating wine. So England has an absolute advantage in creating wool and textiles. Portugal has an absolute advantage in creating wine and a lot of different kinds of wine. And if both countries just do what they're best at and trade with one another, whether you're a consumer in Portugal or a consumer in England, that's going to offer the most amount of wine and cloth to choose from. And therefore, think about supply and demand. If you have more of something, the price can go down. So the best way to get the cheapest and total amount of goods for both economies is to have folks specialize in what they do the best, or have countries specialize in what they do the best. If you have trade barriers, you're inherently taking resources and putting them to less efficient use. So they didn't have the same level of industrialization in Portugal. But if you have trade barriers or incentives or tariffs that try to force some production of wool or textiles into Portugal, you can potentially lead to just an inefficient use of assets. Same thing for England. It's a lot harder to create wine in England. The climate's just not conducive for it. It takes a lot more effort and energy and resources and land to potentially try to grow grapes there. So in that scenario, when you have trade barriers, you end up with a situation where you've got some efficiently produced textiles in England and some inefficiently produced textiles in Portugal, and the same thing with wine. So in total, you just end up with less wine and less textiles if you have a protectionist policies in either or both countries. So as a consumer, when you have less of something, the price goes up, less choice, higher cost, less prosperous for both nations. So Ricardo expanded upon this and actually proved out that even a country that has an absolute advantage in both, they can make wool and wine better, it still is better to trade because there's an unused resource in that other country, and that should still be put to its comparative advantage, and there's an opportunity cost in not producing in that country. So I won't go into too much detail on that, but it basically, both economists proved out why trade is beneficial from a global standpoint. And it's telling to show that the chart, I don't have to actually explain what the different colors and numbers mean. This is just how you would model out the economic impact of a tariff. There's the C in the middle, the tax revenue that you actually collect. And if you look in B and D, this chart has it labeled as a societal loss. And my college textbook, they called it a deadweight loss. Basically, is saying the only way to model it out is to say that we know that resources are being used inefficiently because we're producing textiles in Portugal and wine in England. So all else equal, there's a loss. There's an economic loss to the global economy from that inefficient use of resources. So I just thought that was important to sort of lay out some of the pros and cons and some of the history on tariffs before going to the next slide. So let's put this into the context of history and United States tariff policy throughout time. So if you go on to the next slide here, what we did was we mapped out a history going back to the late 19th century of US tariffs on foreign goods. And you can see there's been significant periods of time where tariffs were higher in the late 19th century, early 20th century. And one piece of old legislation from the 1930s that you keep reading about now, that tariffs are back in the front of mind, is the Smoot-Hawley Tariff Act of 1930. And think about, this is the middle of the Depression. And the idea behind the legislation was, what could be a better way to stimulate the US economy than to put up trade barriers and tariffs and make sure that people are buying American? It's going to keep more people employed in America. It'll keep goods here. And the result was the complete opposite. So looking back, now that the evidence is settled and economists with better measurement tools and insights were able to look back, what actually happened was, after the Smoot-Hawley Tariff Act, global trade fell by 60%, and it's widely credited as being one of the leading contributors to why the Depression was such a painful event, why it lasted so long, because we lost so much foreign trade, so much of our foreign customers for US goods actually outweighed all the benefit of people buying more domestically. And you can see that after World War II, there's a gradual decline over the next 70, 80 years of tariffs as the world became more global. We have the World Trade Organization, we have the UN. There was just a lot more global trade after World War II, and a lot of consumers benefited from that rise of globalization, the low tariff rates we had during that time. If you look, the first time tariffs start to creep up is during President Trump's first term. There was a slight uptick in tariffs for foreign imports. But if you think about some of the tariffs, and we'll go over that in the next page, we're talking about, in the 3.5% to 4% tariff rate during President Trump's first term. The tariffs that we're talking about now are 10, 25%, and in the case of China, north of 100%. So significantly off the top of this chart, which is a little telling. One other piece of historical context: the tariffs here are being applied in a flat way. So historically, even back in the late 19th century, there was a sort of realization that certain things just don't make sense to be produced here, or we can't produce them here, like cocoa or coffee. They grow in very hot climates towards the equator best. It's very difficult. Maybe in the southern tip of Florida, you might be able to grow a little bit of it, but they excluded base commodities from a lot of historical tariffs. So this is the first time we've actually had tariffs on coffee since the colonial era. So it's very unique the way that these tariffs are being applied flatly versus more strategically to achieve specific aims. So if we go on to the next slide, we have a list of tariffs, and this candidly outdated probably the minute we sent it. And, this is going to be a continually evolving area. But you can see there's a lot of different, and I won't go line by line, but there's a lot of different types of tariffs on here. They're against the trade countries where we've had more trade tensions with, like China. But there's also countries on here where we've traditionally had very strong trade relationships, like Canada and Mexico. And the tariffs range from a low of 10%, which again, if we just thinking back to that historical context on the previous slide, 10% alone is a very high tariff. But some of these go up to 25% or north of 100% in the case of China. So, and then looking at all the right side, a lot of times tariffs, because they can be used strategically to help for very specific industries, a lot of these are flat tariffs, which is, again, a little bit uncommon. So it's really unclear at this point, I think, to a lot of market observers, whether or not the intention is to have these tariffs actually go through and collect the revenue and impose the trade barriers and make the world adapt to this new trade regime, or if these tariffs are put on as a bargaining chip to help try and strike better trade deals, or somewhere in the middle. So I think we don't know the answer today. We'll find out a lot more information in the coming weeks and months. So if we go on to the next slide, I want to take just a minute again to explain in a vacuum how trade barriers and how tariffs actually can impact a trade deficit. Because a lot of the rhetoric or the talk in the market is about how this can help potentially improve trade deficits. So this is just a single example of two countries, and then we use the rest of the world too, because it's an important piece. But this is kind of in a vacuum, not considering any retaliatory tariffs. So if you see the dark green line pointing from the USA to China, in this example, the USA imposes a trade barrier, a tariff on China. The classic economic definition is the US dollar is going to appreciate in this scenario because when you're buying a foreign good, you need to sell your own currency and buy that foreign currency to purchase that good. So to buy a TV from China, you have to sell US dollars, buy Chinese renminbi, and that puts selling pressure on the US dollar. It puts some buying pressure on the renminbi. And then you have the US, the currency fluctuates based on that buying and selling movement. In this case, we're not buying as many good from China. So we're not selling as many US dollars. So the US dollar stays high or continues to appreciate. At the same time, because we're not buying as many Chinese renminbi, the Chinese currency depreciates, which makes its currency slightly more attractive towards the rest of the world. So a German consumer may actually find a Chinese good to be cheaper in relative sense because the euro Chinese currency exchange rate is now more advantageous because the Chinese currency is at the margin cheaper than it would have been otherwise. So then what happens is you actually see a relationship where the rest of the world starts to actually shift there and at the margin will buy a little bit more from China and a little bit less from the United States because the US dollar is a stronger currency. It's going to be more expensive, all else equal, for another third country to buy something from the United States than it would have been from China. So what you actually see is our trade with China will fall, the trade deficit will fall. So we actually will import less from China, but we'll also import more from the rest of the world to make up for that lack of import from China. And if you look on the next slide, we actually map this out from looking at two data points, 2018 and then a recent data point, I believe it was as the end of March. And you can see China's been a country where we have had more trade barriers and more higher tariff regime with China. And you can see that bar actually did reduce. Our trade deficit reduced from about 450 billion to call it 325 billion. But look what happens to the trade deficits with all the other countries on this chart. So Mexico, Vietnam, Germany, Ireland, it just shifted our trade exposure to importing more from other countries versus it actually being produced in the United States. So it can be not as straightforward how in a lot of the talk of these tariffs is, well, these companies will come and they'll invest in the United States and more will be produced here. That's not how tariffs typically impact economies. It's more typical for them to impact economies in this way. So next, we're going to go on and talk a little bit about how this all wraps up into an economic outlook. And so we'll go down to one more slide. Here we go. And the direct impacts of tariffs, as we've sort of talked about, they're inflationary. So it does increase, it flatly increases the price of something. And it has the impact also of decreasing growth. So when something's more expensive, you're buying less of it, supply and demand, it's just lower economic growth because there's just less economic activity, less purchasing, less production because things just cost more. There's also some indirect impacts on the, we showed these on the right-hand side, and that can feed into the direct impacts in some subtle ways. So I read a survey recently from the National Bureau of Small Businesses, a survey saying small businesses are likely to spend less money due to the uncertainty. So a decrease in consumer and business confidence and an increase in uncertainty can lead towards lack of investment, slower economic growth. These are some knock-on effects. There's also as we saw in the stock market and bond market, there can be sell-off of risky assets. And there's a negative wealth effect associated with a sell-off in risk assets. So when folks see their investment portfolios decline, there's a chance that they tighten their belt and don't spend as much, which again can feed into lower global growth or lower economic growth. So in total, tariffs do provide a kind of tepid economic situation. And as a result of all this, our outlook was a little rosy going into the year. It's shifted a little bit based on these tariffs, is to go into a mild recession. So tariffs are restrictive economic policy. I read an estimate that it was about, and this is including the pause on April 9th of the reciprocal tariffs, that it's a hit to GDP or essentially a negative fiscal impulse of 2.4% of GDP. So it's likely that we're going to slip into a mild recession. So there's a couple things that make this situation a little bit more unique from maybe past economic crises like the dot-com bubble or the '08 financial crisis. We're not at that level yet. So what causes us to say mild recession versus a medium or more intense recession is that this is policy driven. So in '08, you couldn't snap your fingers and say, never mind, we're going to cancel this policy and the housing market fixes itself. This case, you actually can have a policy change, flip-flop, and eliminate a lot of these tariffs, and the situation could correct itself pretty quickly because it is, in a way, self-inflicted. There's other things within the structure of the economy. Corporate balance sheets, bank balance sheets are a lot healthier than they have been in past cycles. So we don't see the same amount of debt, amount of leverage in the system as we saw in '08. So companies are just healthier, banks are healthier, and we don't see a decrease in lending standards. So if we were to see some of these things slip, that could potentially, even though the economic impact is large, there's a lot of safety nets and optionality to help move us away from a more severe recession. So that's why we're calling it a mild recession is our baseline forecast. Now this could change dramatically depending on how these negotiations go, and do the reciprocal tariffs get implemented as initially proposed, or do they get implemented in a very different sort of way? So that's the outlook. I'm sure there's going to be some questions during the Q&A part about tariffs, about this. But if we go on to the next section real quick, I wanted to talk a tiny bit about the ABRF program. And go down one more slide. There's a number of options within the ABRF program that participants have an option to invest in. So we break this up into 3 distinct tiers just for ease of organization. So the first step, make it easier for me, are asset allocation funds. So there's a series of retirement date funds and then some target risk funds. And the retirement date funds are meant to be invested based on when you're going to retire. So a fund 2025, that fund has an asset allocation mix that's more or less appropriate for somebody who's retiring right now. So it's going to be a lot more de-risked. It's going to be someone who's likely, needing to draw down on their retirement savings, so it's not as risky. There's other funds like the 2055, the 2060, the 2050 fund. These are designed for younger participants, generally younger participants, or people who have a much longer time horizon who are going to be retiring many decades from now, that need to grow their balance in order to hit that retirement goal. So they're going to be much more aggressively positioned in equities and higher growth assets that can be more volatile, but that participant, because of their time horizon, has the ability to weather more significant drawdowns because of that time horizon. There's also target risk funds that don't automatically de-risk, like the target date funds, and add in other elements, other diversifiers, and add in some elements of active management too, which could be a good option for participants who are interested in allocating to those funds. There's also a number of single asset class funds in the I'm saving for retirement section. And these are a mix of actively managed and passively managed funds across a number of different categories. So there's large cap funds, US small cap funds, international equity funds, and then a series of bond funds as well, both active and passive. So for a participant who's more comfortable in making their own asset allocation decisions, they can use this collection of funds to help build a portfolio that suits your time horizon and your risk and return objectives. And then final tier is I'm almost retired or I'm there. These are retiree funds, and these are more objectives-based funds that can help somebody who's thinking in a more objective lens than a asset allocation lens. So funds that if we're just worried about capital preservation, there's an option in there. There's one that's a little bit more focused on income, inflation, and then one if you're looking for a little bit more growth but want to do it in a diversified way. Those objectives-based funds may be the right option for you. There's also a brokerage option offered through Charles Schwab for participants who really want to expand the number of options available on the base program. And if you go to the next slide, we have all these options mapped out in a risk return spectrum. So you can see there's a number of very conservative and also more aggressive, higher return seeking options. It's always a risk and return trade-off. If there was a fund in the top left-hand side, so high return, low risk, there's no free lunch in investing. You can invest across a number of these different asset classes to create your own portfolio, or pick a retirement date fund that fits your personal risk and return objectives. So all this is available in the program offering document to learn more information, but there's a very strong number of options in this program across a variety of different risk and return spectrums to help meet the needs of all different kinds of participants. So that was, I think, my prepared remarks. I can pass it back to Becky for just a few comments on program resources and information.
We'll move right ahead, Loxley. So that was a lot of information, and if you are like me, you haven't heard Smoot-Hawley in a really long time, and I remember being in high school learning about that and thinking, I will never need to know this. Why am I learning about it? And here we are, kind of living history all over again. So thank you for that, Matt. It was really interesting information, and I think we're all kind of living in unprecedented times, and the more we know, the better armed we are to make decisions. But a lot of us need assistance in making those decisions, and the program does have resources to help you do that. We have several options. The first I'll talk about is the overall financial planning through Voya Financial Advisors. These are advisors that you can call and speak to about your overall financial situation that you can see on this slide: managing school debt, retirement savings, personal savings goals. You can get a free personalized action plan on how you can make positive decisions and take action towards improving your overall financial situation. The VFA, as I'm calling it, is a holistic view of your overall financial situation, with specific advice about your ABA retirement funds program plan. We have online advice through Edelman Financial Advisors, through Voya Retirement Advisors. There is an online tool where you can go in if you are tech savvy. It is very user friendly. You can put in some information. It will ask you information about your risk tolerance, your horizon to retirement, your comfort level, other accounts, etc. And it will prepare for you a specific retirement plan within the ABA Retirement Funds program. So it will tell you, move money from this fund to this fund, make your future investments into these funds, and you have a better chance of getting to where you want to be at your retirement goal. It is a very user-friendly and it is a free tool. If you are not tech savvy, or you just like the comfort of speaking with someone or having somebody proactively manage your account, the program offers professional management through VRA as well. So this is where a registered representative from Voya Retirement Advisors will manage your account on your behalf. You'll get a quarterly update. Here's what we've done for you. They will go through the same type of questionnaire, but you'll have a person and you can ask questions. And that gives a lot of people some solace knowing that there's a person there on the other end of the phone you can speak to as much as you'd like. And they'll proactively manage your account. That's a fee-based service, very competitively priced. And if you want any more information, I encourage you to use the QR code on the screen to get more information about any of these three services through the program. A lot of you have asked questions specific about your account. I'm looking at some of the questions that came in pre-registration, as well as a couple that have come in since. We're not going to be able to answer your specific questions, but these folks can. So I encourage you to utilize this resource and just talk to someone or use the tools and figure out what you want to do and what your end goal is in these trying times. Loxley, if we could move forward. If you would like to speak with us, there are 4 numbers that you can call. If you are a participant, please call the participant services line at 348-2272. We have representatives available from 8 a.m. to 8 p.m. Eastern time. And the participant service line can transfer you to an advisor at any time, either VFA or VRA. So feel free to start there. If you are a plan sponsor, you'll use the appropriate services line beneath that. But as a participant and talking about your account, you'll want to use the participant services line. You can always email us at contact@ABA Retirement. And our website also has a lot of information, particularly under the learning resources pages. So I encourage you to look through those services. And if you missed the New Year, New Markets webinar, that's in our learning page as well. Moving on. So I'm going to open up the floor to questions. Again, I shared at the beginning of this presentation that we will share this deck, so you can take your time to read those disclosures. They're important, but we will share that with you afterwards. I'll start with the ones that we got pre-call. All right, Matt, this is the Matt show here. I'm not going to try to stump you, but I think some of these are going to be challenging. So if you need a lifeline or phone a friend, just say the word. Oh, all right, this one's for me. I believe my retirement account is a 401k, but it says profit sharing plan. This is just a fun fact. 401k plans are profit sharing plans. A 401k is a component of a profit sharing plan. So what you have is probably a profit sharing plan with CODA, or that's a cash or deferred arrangement. So one and the same. I am particularly interested in hearing about strategies for participants close to retirement. Now, Matt talked about, we do have a retiree menu that he went into. That is a retiree menu just generally designed for participants closing in on retirement or actively in retirement. But if you really want to talk about your account, I really encourage you to use the advisors. To call them and talk to them is totally free. So it's only fee-based if you engage them to proactively manage your account ongoing. So if you have questions about your particular account, call the participant services line and ask to speak with an advisor. They are there for you to support you. So I encourage you to make that call. We won't be able to give you personalized advice over this platform. Similarly, I invest in long-term stocks. Should I move my money to an IRA? What are your suggestions? Well, moving your money will be cashing out where you're at. So a lot of the times we like to say stay the course, just generally speaking. Of course, again, you'll want to speak with an advisor. There are a lot of reasons to stay in a program, whether you're with the ABA Retirement Funds program or a different qualified plan. They're typically a little bit less expensive than an IRA. You have loan availability. You have different features and products that are available in a qualified plan than are available in an IRA. But, and the program does offer you stocks investments through the PCRA or the Charles Schwab component. So you really do have a myriad of options open to you within a qualified plan. Of course, you're free to move it to an IRA if you'd like, but that's a decision you'd want to make with your financial advisor. So I'd encourage you to speak with one or one of ours. Okay, I'm just going to read you this one, Matt, because it's funny. What do I do in these market conditions, aside from panic, hair pulling, beating the dog, and other normal reactions? First of all, beating the dog is not a normal reaction. But do you have any advice for someone what to do in these market conditions, aside from utilizing the resources that we share?
Yeah, definitely. No, it can be challenging to stay the course on, when economic times get trying, when there's volatility in investment markets, and it can be more, stressful or antagonizing for folks who are closer to retirement, where, younger folks. I would encourage you really can just look past to see it as a buying opportunity if the market goes down and you're regularly investing through your company work plan. Or just through your own personal assets, you're buying stocks on sale that you're going to sell many decades in the future. So it's less of an issue. But I think that if you have a plan, you have an asset allocation that's right for you, and you have the right amount of risk in your portfolio, you should feel comfortable riding just through these periods of economic volatility and taking a slightly longer term view, versus making a reactionary decision to try to move towards cash or liquidate things. Because it could be the wrong time. After the Liberation Day announcements, there was a dramatic sell-off, and over the next couple of days, those dramatic rebounds. So if you had panicked or sold something at the bottom of that cycle, you'd missed a good amount of rebound just right after that. And there's a lot of evidence out there put out by our firm and other firms that talk about missing the 10 best days in the market, or just staying time in the market is better generally than trying to time the market. So a lot of this, just think very carefully about your own risk tolerance, your objectives, your time horizon, and build an asset allocation that's appropriate for that.
There have been some recent headlines about countries beginning to ban U.S. products. Should this occur, how does the U.S. GDP post positive numbers?
Well, yeah, we're thinking, there's a chance that we do go into recession, and that would be the classic definition is 2 quarters of negative GDP growth. So we are expecting that these tariffs are going to have an impact on GDP growth. I've seen fewer headlines about outright banning of products, but a lot more reciprocal tariffs to make U.S. goods a lot more expensive in foreign markets. And all else equal, like we talked about, the deadweight loss or the societal loss. If there's trade barriers in place, there's going to be less global economic activity. Everything slows down, and it's a net drag on both the U.S. economy, but also global economies as well.
How do tariffs impact international investments within my 401k plan? Should I be concerned about my exposure to foreign markets? It's a great question.
So one interesting thing we've seen in this most recent tariff announcements and the start to the year is the U.S. dollar has depreciated pretty significantly. And this isn't tied directly to tariffs, because the classic example we gave earlier was U.S. dollar should all else equal increase due to tariffs. But there's just a lot of uncertainty around the U.S. dollar, U.S. being a good global trade partner, the independence of the Fed. So there's a lot of talk about Trump potentially removing Jerome Powell as chairman of the Fed. So I think it's due to more lack of confidence in shorter term lack of confidence in the United States, which has led to a depreciation in the US dollar. And actually looking through last Friday, the S&P 500 is down 5%, but international equities are up anywhere between 2 and 10%. So it actually has been a pretty good time to be an international investor. And another point to note, and Warren Buffett's talked about this within the S&P 500 too, a lot of very large companies, at the end of the day, are global companies. We didn't talk about this during the webinar, but one area where we have a massive trade surplus is in services. A lot of this talk is around goods. So the items, clothing, cars, food that we import or export with our partners, but the US has a massive trade surplus in services. Think about Google, Amazon, just streaming, Amazon Web Services. A lot of our largest companies, even consulting services, Accenture, I'm not supposed to name individual companies, but KPMG, the accounting services, we're an advisor, banking, and technology service provider to the world. And those are global revenues. So I think if you look at the largest companies, whether they're in Europe, Japan, emerging markets, or the United States, there's a lot of global revenue from all these companies, and all else equal, it should just be, there's not a lot of strong evidence to say that international companies are going to be disproportionately impacted relative to domestic companies.
What sectors of the economy are most likely to be impacted by tariffs?
Yeah, I think it probably is the more traditional manufacturing areas. So there was just an announcement this morning coming in. General Motors announced pretty poor guidance. I think they're cutting their stock buyback program. It's more real companies that have cost of goods sold or real inputs that are driven off of import and export. Another example, that's funny how the media latches onto individual stories. Apparently, I didn't know this before the tariff announcements, but there's no manufacturer of car seatbelts in the United States. They're all in foreign countries. So you can't actually, if you wanted to produce only cars using only inputs from the United States, you couldn't do it because there's no seatbelt manufacturer.
Wow.
So our option is we need to import them because we're not making them today. We could set up factories 2 or 3 or 4 years from now that could potentially make them there. But in the short term, at least, it's likely that we're just going to pay the tariff, and it'll ever so slightly increase the price of other goods. So I think there, more so than services aren't covered under the tariffs.
Or if there's any entrepreneurs that want to start a seatbelt making business
Yeah.
in the US, then now's your time. What's going on with the bond market?
Yeah, this is another challenging one because there's a confluence of events. We're in an inflationary period, but the Fed just started cutting rates. There's questions around the independence of the Fed. Inflation is still higher than our long run average. And then you throw tariffs all in that cauldron and you try and come up with, what is the rational path forward for bond markets. In the short term, bonds have been a good diversifier to, there's not a lot of volatility, I should say, in rates, but in totality, bonds have been a good diversifier. They're up slightly, low single digits, I think 2-3% year to date for the Barclays aggregate. So they have done a decent job in the short term of diversifying risk against bonds, but it's harder to tie a one-to-one correlation with tariffs in the bond market.
This one's for me. I am almost 73 and still working. Will I need to take a minimum distribution? Can I still contribute tax-free? You can still contribute if you are still working and earning with the firm. Whether you need to take a minimum distribution depends on whether or not you are a 5% or more owner of the firm you work in. If you are a 5% or more owner of the firm, you will be required to take a minimum distribution this year. If you are not, then you may delay that until you terminate employment. Okay. Oh, you've kind of already answered this, but I want to make a statement about it. So this comment is, personally, I am scared and have not opened my first quarter statement. What should one do if planning to retire at the end of 2030? Matt did talk a little bit already about those people nearing retirement and what to do. I would encourage you to speak with one of our advisors or even possibly a VFA advisor to look at your overall holistic financial situation to determine what your next and appropriate courses of action should be. You still have 5 years, so that's the good news. And you definitely, there are things that you can do to protect your assets. But I would encourage you to look deep within and find out your real risk and tolerance and speak with an advisor to make an informed decision. Okay, you kind of already answered this, but I'm going to just, because it's specific. I've always understood bond funds are conservative and somewhat immunized against swings. Please explain to me, as if I am 5 years old, why the bond market recently crashed and what are the implications?
Yeah, and I think there's been a lot of volatility in rates markets, and I think, or bond markets, and they have rebounded a little bit, probably since you might have last looked. And there are periods of time, we talked about this a little bit during the New Year, New Markets webinar, but traditionally stocks and bonds are very diversifying to one another. They tend to be a flight to safety when there's economic uncertainty or the stock market's selling off, people rotate into a safer asset, and bonds are traditionally a safer asset, especially government bonds. But there are periods of time, and that was captured kind of recently in 2022, where stocks and bonds can fall at the same time, and that positive correlation benefit can break down. And those are specifically during periods of stagflation or rising inflation and slower economic growth, when you see the Federal Reserve has to increase interest rates dramatically, which puts pressure on fixed income, but also has the effect of slowing down the economy, which can have an impact on corporate earnings and the stock market as well. So it's a necessity to combat inflation during these periods of time. When we saw it in 2022, we saw it in the 1970s. It's necessary to do, but it can be painful in the short term for stocks and bonds. And that's when additional diversifiers like real assets in an investment portfolio can be beneficial, because those assets are more responsive to those high inflation and high rate environments. Hopefully that answers the question.
I don't know a 5-year-old that would ask that question, but I think you did a great job. Is there any type of Roth IRA or similar option for higher wage earners? There is not a Roth IRA for a high wage earner, but there is a Roth 401k for a high wage earner. So you are eligible to put away post-tax dollars via Roth into your 401k and save up to the $70,000 limit this year. So that's a great option for you. If you are self-employed, you can also think about a cash balance plan. That's another option that's available. It's a really attractive feature or plan for people with not a lot of participants in the plan. If you're interested in that, I encourage you to reach out to us at contact@av8retirement.com, and we'll be happy to explain to you what the cash balance plan is and set you up with a consultant that can help you determine if it's a good option for you. Okay, looking at the chart regarding the tariffs and the depression date, If the tariffs are imposed again this year, will the same result happen this year as in the Depression era? Kind of a crystal ball question.
Yeah, I think not. There was a lot more than the Smoot-Hawley Tariff Act that caused the Great Depression. It was really caused by the Great Crash of 29. So it was a stock market crash that led to a number of bank failures, which there's lack of regulation in the economy. There's a lot of leverage in the stock market, a lot of borrowing to pay for stocks because there was very little regulation or oversight of the stock market. There was the Dust Bowl, which led to an agricultural collapse and a loss of a lot of jobs. So it was a perfect cocktail of horrible scenarios that the Smoot-Hawley Tariff Act just threw fire onto that crisis. I think there's a lot has changed and evolved since the 1930s that help to insulate a little bit from future, the tariffs in and of themselves causing us to slip into a recession that great.
If I want to change my current investments to one of the projected retirement date investment plans, can I make that change myself through my online account? Or do I need to call someone to help me do that? Also, are there fees associated with making a change? I will take that. Yes, you can do it on your online account. You do not need assistance to help. Anyone doing it's really simple to do it online. Of course, we're happy to walk you through that process should you need help, but it is a very user-friendly website, and there's no fee associated with making that change. Oh, here's a funny one. Should we panic and start moving our funds to a conservative allocation?
No, I would say just no. Anytime you say panic and investments, it's usually not a good, those two words you take a step back, take a breath. And like I said before, focus on long-term risk return objectives, diversifying effectively, taking a longer term view. Even if you're somewhat close to retirement, there still is some time to recover from this. And, if you're having an asset allocation and a risk tolerance to absorb some bit of a drawdown, it would be much better than panic selling right now. But again, it's a very personal decision, something you'd have to talk to an advisor about or evaluate on your own circumstances.
Yeah, and our advisors are here to help you, and no one makes good decisions in panic mode. Will mortgage rates be impacted?
Yeah, good question. Mortgage rates are tied very closely to the bond market, and there's a lot going on. Like I said before, with the inflation coming down, but coming into this year, the Fed had started cutting rates, which was starting to gently bring down mortgage rates along with it. This is very uncertain what's going to happen from here. In all likelihood, there's going to be a one-time bump up in inflation if tariffs stay, because tariffs are inflationary. It's sort of a one-time shock to the system. Unless the tariffs increase every year, you shouldn't see the inflation caused by tariffs to increase every year. But in a time when we're looking for inflation to come down so the Fed can continue to cut, it just adds more uncertainty and likely could cause the Fed to maybe delay some cuts or maybe cut fewer times. But it doesn't change the long-term view that inflation is coming down in the very long run and rates should follow down in the very long run. I think there's still a question of what is the new normal rate? Is it 1.5%, 2%, 2.5%? Well, I'm not sure where we'll land, but in all likelihood, if the economic projections play out, inflation does fall, rates get cut, mortgage markets will follow that rate cutting action, and they'll fall as well.
Speaking of inflation, is the inflation we've experienced the past few years related to the tariffs imposed during Trump's first term? This is a political question.
So
no, obviously the inflation we've experienced the past few years are not related to the tariffs imposed during Trump's first term.
No. It really was a culmination of the COVID stimulus measures and more COVID impacts than tariff impacts that caused inflation to rise so high. Supply demand,
yeah.
Disrupted supply chains. There's a lot of reasons why we had on that, but the tariffs, again, they were really small. We jumped up from maybe 2.5% to 3 or 4.5%, but it wasn't a meaningful move higher compared to what we're talking about today.
I was going to retire this June at age 64, but it looks like this might not happen. I was hoping to get part of my income from Social Security. Do you think Social Security will still be around in a year?
Yes, it will be around for it's. This is again a politically charged issue. The Social Security Trust, it can fund benefits. My understanding of it, not being an expert on Social Security or the funded status of the Social Security Trust, that we're still as a little bit of a runway to pay full benefits, and then the amount of money taken in from current workers, there's a gap between, and I forget if it's 15 or 20 years down the line, but there is a point in the time where the math is not working positively given demographics in the United States. There's more seniors and folks who are going to be drawing on the Social Security Trust than folks work in the workforce contributing to the Social Security Trust. So that'll be a political issue that Congress will have to sort through to figure out how to right size that. Do they means test? Do they cut benefits? Do they increase taxation to, meet the demand for Social Security benefits? So I think next year we're probably pretty safe. It's a very touchy issue though because seniors vote. So and cutting benefits is just challenging when you've made a promise to somebody throughout their whole working career that you'll get X and then to have to go back on that. So it's a challenging issue Congress will have to sort through.
For now, should we just put money in a savings account?
My vote would be think very carefully. I'm gonna have to sound like a little bit like a broken record. It sounds again like not making rash decisions and investing is generally the right course. To have a plan and stick with it. So when times are good, stick to your plan. When times get bad, you have a plan to stick with as well. And don't forget, we've had back-to-back years where the S&P was up 25%, 2 years in a row, which is an astoundingly strong return for a 2-year period. So I know this feels particularly tough given the circumstances, not just a regular market correction of 10%. There's a lot more behind it. But if you have a plan, if your risk and return allocation is in line with your time horizon, which means you're going to own some bonds, you're going to own some real assets, you're going to own enough diversification to stick through your plan through the good times, you should hopefully be able to stick through that plan in the hard times as well.
To weather the storm. Excellent.
Yeah.
Similarly, things have dropped drastically in about 6 years away from retirement age. Everything Matt just said.
Yeah.
And again, utilize the resources, contact an advisor, talk to somebody. You need to do what's best for you. Can you contribute to a Roth 401k if you're maxing out your traditional 401k? No, those are aggregated. So you can contribute either Roth 401k or traditional 401k or a combination of the two, but the limit is the same. So the limit is, I think, 23,500 this year plus catch up. If you are age 50, and there's a little bit more. If you're between age 60 and 63, thanks to Secure 2.0, you contribute another 11,000 plus. So that is aggregated. So you can do either Roth or traditional or a combination of the two, but they're not like 1+1. Okay, so basically are tariffs good for us?
I would say the tariffs are economically damaging. They reduce global trade, they increase inflation, they reduce global growth. And this is pretty well proven out throughout history. It was written about and discussed in the late 18th century, 18th and 19th centuries. It's been pretty well understood. It doesn't mean that governments can't use tariffs strategically or use them to meet very specific objectives. But it's challenging to understand right now, if these tariffs were put into force, and this is just purely from an economic standpoint. It's like a doctor looking at. I see myself like
not a political conversation.
Yeah, exactly.
It's an economic conversation. Yes.
Economic, discussion, and the way, like I said before, the way you model it is you have to model in an economic loss to make the math work when doing a tariff analysis. So I'm not.
You just got to thank you for your honesty. That was
Yes.
very nice.
Yeah.
We have gotten through most of the questions. The questions that we didn't get to are very specific in nature, so I will address those via email after the call. But I want to thank everybody for participating today. Matt, thank you especially. I found your knowledge about this is really great, and your ability to put it in layman's terms is astounding for me. So thank you. I hope that all of you enjoyed this presentation today. As stated at the beginning of the call, we will be sharing the recording of the presentation as well as the deck after the call. So you'll have this information and feel free to share it with your colleagues and friends. And thank you all for participating in today's website. I hope you have a great afternoon. Take care.
Thank you.